Vaibhav. In today's session of Visual JForex, I will be introducing you the new indicator named standard deviation. We will see how we can design and develop the algorithm for the trading opportunities to be exploited in the market using this indicator. As the name suggests, this indicator gives you the idea of the deviation from the mean level. So whenever you see that there is some deviation from the average price, you can infer that there is volatility, increased volatility in recent time, and it might be the marker that some sort of momentum shift is taking place, and this could be the opportune time to get involved for the new trade. So we will see how to go about defining and designing this algorithmic setup using the standard deviation. You will find this indicator listed amongst the oscillator indicators just below the RSI. Here it is, standard deviation. We have to define these 5 input values depending on which we will have this output value of the standard deviation, and we are using multiple time frames to whenever we will be deciding to trade. We will be using the standard deviation on the hourly time horizon, and along with that we will also be looking at the price action of the 4 hourly time period, and using this confluence we will try to get for the profitable trades. So I will take you to the JForex platform, and this is the USD JPY chart. This time around we will use the USD JPY as our default instrument in place of Euro USD, which we mostly use, and we will use these default settings of 5 candle periods and 1 standard deviation from the mean. And as you can observe from the chart and this standard deviation plotting on the lower side, whenever we have substantial move away from the average price or last consolidation phase price levels, you will see these standard deviation shooting up. It doesn't matter whether the price is moving up or whether it is moving down. This time around the price moved lower, the standard deviation went up. This time around the price moved higher, the standard deviation went up. So this is agnostic to the direction of the trend, and it simply gives you the idea of the strength of the trend. What we will do to find the direction of the trend is simply rely on the price action. We will see on which side the candle is closing, whether it is closing higher or lower, and accordingly we will take the decision whether to go long or whether to go short. But the primary factor while determining that is going to be standard deviation, as it is going to give us the idea for the momentum and the strength of the momentum. So that's how we are going to proceed, and we will consider the last hourly candle periods output for the standard deviation. It should be at least twice of the output value 2 hours back. So we will consider the last hourly candles standard deviation output and compare it to the standard deviation value with the loopback period of 3. So that will get us the interval of 2 hours, and we want the standard deviation to have more than doubled in these 2 hours. So whatever was the output value 2 hours back, it should have doubled, and now in last hour it should have risen more than 2 times, and it should be higher than 2 times of whatever was the output value. And that is how we are going to place the order, and then we will consider the price moves, whether the closing price for the last hourly candle is higher or lower. If it is lower than the opening price, then of course we will be looking for the shorting opportunities, and to make sure that momentum is sustained, we will take the price action of the last hourly candle as well as the penultimate hourly candle, and in both these hours the price should have declined for the sell trade to be executed, and if we are looking for the buy trade in last 2 hours, the price should have risen. We will also be considering the difference between the last hour's closing value and the opening value for the penultimate hourly candle, and we will take into consideration whenever we will be placing the order. And along with this, we will also be taking the help of the longer time horizon of the 4 hourly candle, and we want that whenever we have the hourly conditions in place, prior to that the 4 hourly formation should also be indicative of the continuation of the trend in the same direction, whether it is buy trade or sell trade. We want to make sure that the momentum has been on this side for at least some time, and now it is increasing the pace. Now it is growing stronger, and this might be the opportune time to get involved. So this is the idea, this is the logic for this algorithm, and we will consider the 4 hourly candles output. We will use the 4 hourly candle of the look back period 2, and we will want it to have closed higher when we will be looking for the buy trade, and it should have closed lower when we will be going for the sell trade. So now we head back to the Visual JForex board, and here first thing which we will need to do is get the instrument subscription done. And to do the instrument subscription, I'm going to take the on candle as the start point. Default variables, default instrument should match the candle instrument. I will change this default instrument to USD Okay, on candle, candle instrument, oops, I seem to have missed out on it. Okay, here it is. Position info, all positions, position amount needs to be at 0, and after that we will join it to standard deviation block. This will be of hourly candle period. Shift will be 1, time period is going to be 5, and standard deviation 1. shift is going to be, I think I will have to check the charts once, because we want the interval of 2 hours in between the 2 hourly candle. So that means the shift will have to be 1 and 3. So this will need to be changed to 3. Now the interval between these two candle output for the standard deviation is going to be 2. Okay. Now we will also have to take into consideration the price action, and for that we are going to need the components, info components, get historical candle, two of the hourly time candle period, hourly candle period, and one of 4 hourly and two more of 10 seconds each. This will need to be changed to hourly. Shift is going to be 1 and 2. For this block, the candle period is going to be of 4 hours, and the shift value is going to be 1, and these two will be of 10 seconds each. Shift value of 1 and 2 respectively. Okay, so these are going to be the building blocks for our algorithm. We will be taking the help of these blocks to look at the price volatility, and if it is good enough, only in that scenario we will be going to place the order. Now there are a couple of calculations which will need to be done, and one of the important one is going to be looking at the difference of the closing and opening value for these candle 16 and candle 17. Whenever we will be looking for the buy trade, we will have to make sure that the price volatility has been good enough, and we will consider the candle 16's closing level, and it will need to be higher than the candle 17's closing level, and of course the candle 17's closing level should in turn be higher than its opening level. So that will mean the continuation of the upward momentum and it will increase the profitability. And when the momentum is bearish, we want the last hours, which is the candle 16's closing level, to be lower compared to its opening price, and candle 17's closing level should also be lower compared to the candle 17's opening price. So now let us take into consideration this price volatility and carry out the calculations. We will take into consideration the candle 16's closing level, and we will deduct the candle 17's opening value when we will be looking for the buy trade, and when we are looking for a sell trade, we will deduct the candle 16's closing level from the candle 17 opening level to make sure that the resulting answer is in positive territory. So first block, candle 16, candle close, candle 17, A1 minus A2 is going to be the buy difference, and for sale we will need the candle 16's close to be lower. So now we have to deduct the candle 16's candle close from candle 17 candle open. Oh, I think here I got it wrong. It should be opening price. So pardon me. Now and deduct candle 16 candle close from that level. Again, it is going to be A1 minus A2, and this will be used to define the requirement for the execution of the sale trade. So I hope you have been able to understand why these calculations have been carried out, the logic behind it, and with the session coming to an end, I will be stopping here. But of course, we will be continuing this work in the next session tomorrow probably. So do come back for understanding how you can execute the trades using this algorithmic setup. Thank you all for joining in. Do subscribe to the Dukascopy webinar channel to stay updated on market developments. You can also follow us on the Facebook. Do check out our Facebook page. And if you want to start trading, you can also install the JForex platform along with the Visual JForex platform. And if there is any assistance required in setting up both of these platforms, you can write to me in the feedback section. I look forward to it. See you next time. Goodbye.